Last year we had rate hikes, but the markets tanked. So maybe there's no correlation? I'll let you explain.
I'm not sure that there's no correlation per se, but go back to the premise of the lead up, right? The strongest, longest bull market in U.S. history. That means that there was a lot of overvaluation that was priced into the market. So more downside than what we would expect. In addition to that, the Fed has not been as aggressive in a tightening campaign as it has since last March, since 1981. So this isn't your grandfather's tightening cycle, if you will. This is much different. And though markets are anticipating, and I would even dare say need for the Fed to pivot, there's not been an indication that they're willing to necessarily begin to ease policy mid-year, and that will keep pressure on earnings, and that will keep pressure on the stock market. I think that there was so much, the abundance of liquidity that we had in 2021 while the Fed was insisting that inflation was going to be transitory. A lot of that manifested in companies that didn't necessarily deserve billions and billions of dollars of funding receiving it. It's kind of when the emperor is seen to be naked. You know, in the year that followed, we've seen all of these layoff announcements coming out of Silicon Valley, which is basically an admission, if you will. You know what? We got too much money. We hired too many people. We don't have a business model that can withstand even a small slowdown. And here we are. Now, fast forward a year, and we're seeing those job cuts begin to broaden out. But last year, I think, was a lot of getting that massive layer of overvaluation out of the markets. I don't think the bearish factors are reversing as much as investors are anticipating the Fed easing cycle. And they need it as well. And they really want to believe that the shrinking of the Fed's balance sheet is something that is imminent, if you will. That being said, you know, the debt ceiling drama that we're going to see played out day after day after day into June, you know, the Treasury is going to be pumping money into the economy that was not necessarily anticipated when the world didn't realize that we were at the brink of this debt ceiling being breached. Normally, the US government has to keep a minimum balance in their checking account, if you will. They're not allowed to breach a certain level unless, as Treasury Secretary Yellen has started, emergency measures go into effect. And then the government is allowed to push liquidity into the markets, which is great because it effectively neutralizes the effect of the Fed pulling liquidity out of the markets via quantitative easing. There has been a continuation of bank lending that has been going on. We know that those lending standards are beginning to tighten. Regulators have begun to take notice of a lot of the bad debts on bank balance sheets. So I think that source of liquidity is going to ebb as the year continues. But if you look at the biggest picture, M2, the growth of the monetary aggregate, you know, it actually hit zero at the end of November. In a data series back to 1959, we have never seen money growth slide down to unchanged. So, you know, there is a lot of optimism in the market, but in terms of actual monetary aggregate liquidity, what money growth is telling you is that the exact opposite is occurring right now. There's several big banks who have come out and begun to warn about, you know, we might actually be talking about disinflation in 2023, the unthinkable 12 months ago. And yet M2 money growth is telling us that that is exactly what's percolating. If you looked inside of the producer price index, a year ago, we were talking about pipeline pressures building that were going to funnel through to the consumer price index. Now we're looking at the opposite dynamic. We're seeing price line pressures abate in the producer price index, which means that they're going to be coming down in the consumer price index. And just open your eyes and look around. I mean, rents are coming down at a faster rate than anything in the history of mankind. The housing market is corrected faster than any Fed tightening cycle in history. You're not paying above MSRP for cars anymore. You're actually paying below. These are all examples of how disinflationary pressures are building in this economy. I think to say that the health of the labor market is all right is probably a good characterization, but it's as if we're living in two different parallel universes. because we wake up every day to these massive layoff announcements. And by the way, I'm not just referencing Silicon Valley.
Yes.
You're seeing across a broad range of industries, from manufacturers closing plants to logistics firms to healthcare. So you see these headlines, and yet it's not manifesting in the data. And I'll point out several things. We've seen temporary hiring decline for 5 months in a row. That is always a signpost that your economy is at an inflection point. The Bureau of Labor Statistics notoriously, historically, has been unable to peg inflection points, namely because they use this birth-death adjustment, this fudge figure, if you will, that does a very bad job of catching inflection points in the labor market. That's why the payroll and the household surveys are broadcasting such different messages on the labor market. And then finally, as it pertains to jobless claims, Challenger, Gray, and Christmas reported that seasonal hiring in October, November, December, very important, but that seasonal hiring was weaker than it had been in more than 10 years. And that ergo, when you try and seasonally adjust the data based on prior years of large amounts of hiring in the fourth quarter, it necessarily implies large amounts of firing in the first quarter, but we're not seeing that because the payrolls weren't increased in the final 3 months of 2022 the way they normally would have been. So I think the statisticians, and I'm not a conspiracy theorist, you know this, but I think the statisticians are having a very hard time with seasonal adjustments, and that we are going to be working our way up to an unemployment rate shock. If you look back at history, anytime you've seen the unemployment rate rise by more than 1%, the economy has been slammed into recession because the momentum tends to carry through to a higher number. Bear in mind, we're talking about a 2 percentage point decline in the labor force participation rate. There are millions of Americans collecting disability because they have long COVID. It's just but one example. But again, the base on which you're measuring the unemployment rate is a depleted labor force. And you have to take the entire calculus into account, or you're missing the full picture. But again, look back at any historic cycle in any time that the unemployment rate rises by more than 1%, and the Fed has put us in recession. In times of disinflation, the ultimate type of disinflation eventually is the disinflation in your paycheck. So you should be looking to be defensive because discretionary purchases, whether goods or services, are going to be harder. They're going to be harder to finance if you're in a disinflationary environment. So things that are defensive, such as staples, are going to be better places to hide. It's with good reason, I think, that gold has finally taken off from its long hiatus, because gold does well during times of disruption, whether it's inflationary or disinflationary. People forget to look back at the full history of gold prices.